So today we are going to talk about earnings per share, that is under International Accounting Standards 33. So I think you can be able to see my screen on the other side. That is okay?
Yes.
Yes.
Yes, yes.
So when we talk about earnings per share, we always say that in every financial year, in a certain period, in every financial period, an organization is supposed to make a provision, is supposed to calculate earnings per share, that is basic earnings per share and diluted earnings per share. So when we talk about earnings per share, these are about now the profit which is attributable to ordinary shareholders for every ordinary shares held in a company. So let's say, for example, you hold some shares in a Safaricom, or you hold some shares in KQ. Right now, KQ has been doing badly. So if KQ was supposed to pay you the relevant profit on the shares held, remember that they have to compute earnings per share. So earnings per share is all about the profit attributable to ordinary shareholders for every ordinary shares held in the company. So I request you mute.
Okay.
When a question comes, you ask. So I was saying that if KQ could have been making a profit, right now it has been making losses, but right now the other day, there was a loss which was reported of around 30 billion. So if it was operating in a profit, remember that they have to compute for the earnings per share. So the profit attributable to ordinary shareholders for every ordinary shares held in the company. So let me use a good example of Safaricom. So Safaricom has been doing very well. So obviously they have to pay, so they have to give some profits to their shareholders. So they always compute earnings per share. So the profit attributable to ordinary shareholders for every ordinary shares held in the company. So as per the standard of International Accounting Standards 33, remember that you have to compute basic EPS and diluted. Basic and diluted. Of which, what you need to know is how to compute basic. How to compute basic and how you are supposed to deal with diluted. So to start with basic, so basic is calculated, obvious, basic earnings per share. This one is calculated by taking, so we say that basic EPS, you take what we call powers. We say powers over 1/0. Powers over 1/0. So when I say powers, I mean profit attributable to ordinary shareholders. When I say 1/0, I mean weighted average number of ordinary shares. Weighted average number of ordinary shares. Of which, what you need to know about powers. So powers is all about, you start from the profit after tax. You start from the profit after tax. So sometimes they call it a net income. So it's called net income. So you talk about profit after tax. So after the profit after tax, you have to subtract profit attributable to NCI. Profit attributable to NCI. So profit attributable to NCI. So profit attributable to NCI. NCI, these are minority shareholders. So you start from profit attributable to, so you start with profit after tax, you raise profit attributable to NCI. Then after profit attributable to NCI, you talk about preference dividends. So you raise preference, so you deduct the preference dividends. So raise the preference dividends. So after subtracting the preference dividends, remember that you can add or you can less extraordinary items. You can less extraordinary items. Add or less extraordinary items. So you add or you less extraordinary items. So and mostly in most of the questions which I have came across under the casting paper under advanced FR, you always find that the first three are the ones which are obvious present. So profit after tax, profit attributable to NCI, then preference dividends. talk about the preference dividends. So after that, we need to talk about the one-offs, the weighted average number of ordinary shares. So the one-offs. So one-offs is all about the shares. We talk about shares weighted. You weigh shares weighted according to the time factor. So you weigh shares according to time factor. According to time factor. So I can write this one on the other side here so that it can be clear. So we have said one-offs. It's all about the shares. Shares you weigh. So which shares do you weigh? Remember that it's all about the common shares. Talk about common shares. So the common shares, they are the same as what we call ordinary shares. So that is the same name, ordinary shares. So you weigh the shares as per the time factor, as per the time factor. So let's say, for example, if you have a company which issued shares. So for example, they can say this, we have a company A with an outstanding ordinary shares of 200,000 on January. So how can you weigh those shares? Remember that the shares which are outstanding from January will be weighed for 12 months. So they were there from January to December. So you say 200,000 times 12 over 12. So you weigh for the entire year. What if it came in and issued other shares in July? So remember that July to December, those are 6 months. So you multiply. So the shares which were issued, you multiply with 6 months. So we can take an example here on my short notes so that you can be able to understand what I'm saying. So I've already said that. I've already said this. I've already said that the basic EPS. So these notes, I think you have them. We say that basic EPS is calculated by dividing profit or loss for the period by weighted average number of ordinary shares outstanding during the year. I have said weighted average number of ordinary shares, not preference. Are we together? So I've said that basic EPS is all about the profit attributable to ordinary shareholders. You divided the weighted average number of ordinary shares, not preference shares, of which I've said another name for ordinary shares is common shares. So whereby now already I've said, so the next thing I think they would be mentioning in our notes here is all about how do you compute? Because you can see we are saying where the profit attributable to ordinary shareholders is all about, I've said you start from profit after tax. So the profit after tax. So that is the one for the year. This is after tax. So the profit after tax. So that is after tax. You raise the preference dividends, then you raise profit attributable to NCI. Then what about one-offs? This is one-offs, the weighted average number of ordinary shares. So the one-offs. So the one-offs represents outstanding number of ordinary shares weighted for time factor. So this is the next example I will be doing, this one. So I think it's feasible on the other side in a good manner. And
yes.
So that is the example which I've just enriched. So they say that. Assume a company has what? 2 million ordinary shares outstanding on 1st January 2007. On 31st March 2007, the company issued 800,000 new ordinary shares. So calculate the weighted average number of ordinary shares. Calculate the weighted average number of ordinary shares. So how can you go about it? How can you do this? How can you do this, Anne? I'm just asking you. How can you weigh this? This just, I need an explanation from you. How can you weigh? Give it a trial. So I've said that, I've said this. Remember that I've said that in order to get the one knows, what am I supposed to do? To weigh the ordinary shares as per the time factor. So now for example, now assume that a company had 2 million ordinary shares outstanding on January 2007. That is the start of the financial year. So those 2 million shares, for which period are you supposed to weigh them? You weigh them for which period? For the entire year, because that is from January to the end of the year. So they were there from January. Then they issued others on 31st March. So also you consider the one which were issued from 31st March to the end of the year. Now, from 31st March to the end of the year, those are how many months? Those are around 9.
9.
Yes. So what I will be doing here, you can weigh them in 2 ways. So you can do these things in 2 ways. So of which you will choose, which is the easier one. So the first one, you can talk about, we were having 2 million, of which they were there from January to the end of the year. So this one is from January to December. So this is January to December. So of which we have a figure of, it will be 2 million. So then coming, so I could have written date here. So this space is enough. So January to December, so that you can be able to understand well. So January to December. So then they issued others on 31st March, which means that that is from April. So that one is from April 1st. That is from April 1st to the end of the year, which is December, because it was at the end. It was at the end of March. It was at the end of March. I think you can see that on 31st March, which means that from 1st April to the end of the year is when you weigh now these shares, the 800,000. I think that is fine. So then, those are 4 many months. We say those are 9 months. So if you use your calculator well, you can give me the answer. So if I take 9 out of 12 times 800, so that is 600,000. So that is 600,000. So that my total weighted average number of ordinary shares is 26. So 2.6. So that is fine. Or you can do this way. Or you can say, the one which were there from January, you talk about being there from January, the one which were outstanding, you consider them from January to the 31st March, when they issued the others. So that you say 2 million times how many months? So this 2 million times 3 over 12. 3 over 12. So that is around 2 million. So 2 million you divide by a quarter. So that is 500,000. So that is 500,000. Then you talk about now from April, because now from April, that is by the end of March, they issued another 800, which means that it's from 1st April now to the end of the year, which is December. So that the total amount, remember that they started with 2 million, which was outstanding. Then coming April, they issued others. So the 0.8, the 800,000. So that the total is 28. So 2,800 is the one now you weigh from April to the end of the year. That is how many months? 9. So if you say 2.8 times 9 over 12. You talk about 21. 21. That is 2.1. So if you add 2.1 and 500, you get 26. 26. So which is the easier way you can weigh those shares according to you? According to you, Mungeri, which is the best way you can be able to weigh them? You can use scenario 1 or scenario 2, or which scenario have you understood?
Scenario 1.
Yes, scenario 1. So that is fine. So you consider the one which were there from the start of the year. You consider them for the entire year. The one which came in during the year, you consider them also from that period when they were issued to the end of the year. And so that was example 1. That is a simple example. So that is now how you will be preparing. Now we are preparing towards doing a bigger question. We will be preparing towards doing a bigger question on the past paper. So that is the point where we start. So you can see that was the answer. That is the answer as provided there. So then there is an illustration here. There's another illustration whereby they say, the following are the details from the consolidated income statement of Maendeleo Limited. They could have used even Machoka Limited. For the year ended 20th June 2007. So we have profit from ordinary activities after tax, minority interest, profit attributable to members. So that is after you have subtracted minority interest. Then even they went ahead to subtract preference dividends. That is fine. They got 381,500. Then we have an ordinary dividend proposed of 17,500. Then the company has 750 million shillings 5 ordinary shares outstanding throughout the accounting period. So the examiner need, so even I've provided the answer there. Anyway, I would tell you we arrived at the answer, but this is just direct. Can we calculate or just I explain? Yes, I need let's calculate. So yeah, this is the way we calculate. So you know that, anyway, this one doesn't need a lot of calculation. You know that what they were asking on this question is all about, they were asking what? They were asking calculate basic EPS, of which you know that basic EPS is all about powers over owners, profit attributable to ordinary shareholders. So you say that basic EPS is equals to powers out of owners. Powers over what? Owners. So in this question, you already have powers. Because we said powers is equals to what? If you are keen in class. Profit attributable to ordinary shareholders. How do you arrive at that?
Profit after tax.
You
less profit attributable to NCI. Then you also less preference dividends.
Yes, preference dividends. So you don't raise ordinary dividends. So that is why you can see here the answer was direct, because already they started in the question they started with profit from ordinary activities after tax. We subtracted what was owing to minority shareholders. We got 389. Even we have subtracted preference dividends paid. Are you seeing that?
Yeah.
Yes. So which means that our powers is 381,500. So never take 364, because 364 is after even they have subtracted ordinary dividend proposed. But our scenario, we know that the way you have said that is the format. So our powers would be 381,500. 381,500. So this is 381,500. So that is our powers. What about one-o's? How do you get the one-o's? One-o's is just the shares you weigh. The shares you weigh for time factor. You weigh the shares for time factor. On this scenario, how many shares, ordinary shares, were there? The company had 750 million shillings 5 ordinary shares outstanding throughout the accounting period. What is now the one was there? Which is the one was?
750.
So our question
Then
you
weigh, we are going to weigh 750.
So remember, this is in thousands, so you can make it 750,000.
Okay.
Yes, so because they have said millions. So see, you weigh out, because now it's direct, because now here, see, it was outstanding throughout the accounting period, which is the entire year.
Yes.
So you say 750 times 12 out of 12. Because yes, that is 750,000 times 12 out of, because it was outstanding throughout the year. Yeah, so it means that here you divide 750,000, divide 750,000, you divide 750,000. So you take 3 to 1, 500 divided by 750,000. So that is 0.59. 0.59. So you always say that shilling 0.59 per share. So always your answer say that per share. That is fine. I think that is not something you need to use a lot of time there. So that my next illustration, I think those illustrations you are getting them correct.
Yes, yes.
So then the next thing, issue of new shares ranking for dividends in the period of issue for cash at full market price. So this is a small heading. So issue of new shares ranking for dividends in the period of issue for cash at full market price. So we say that, for example, so in order to understand this, when we say issue of new shares ranking for dividends in the period of issue for cash at full market price. So there's an example there on which they say that the issue and the fully paid share capital of Mahindra Limited on 1st January 2007 comprised 4 million. This is 4 million. Comprised the 4 million. So it comprised the 4 million, 7% cumulative preference shares of shillings 10 each, and the 3 million and the 3 million ordinary shares of 10 each. On 1st September, a further 600,000 ordinary shares were issued and fully paid in cash. The profit after tax for the period was 10,976,000, 10 million. So in short, what you need to understand here, they are asking in short basic EPS. So basic EPS, we calculate again. We do our calculation. So remember that like now I can explain and we compute, no problem, no worry. So they are saying that this issue of the issue and the fully paid share capital of Mahindra Limited on 1st January 2007 comprised, it was issuing preference shares 4 million, of which their rate is 7%. So the return from there is the return from preference shares is dividends. I think you know that. So on this, they will be paying if they issued preference shares, they pay dividends. And there was ordinary shares. The common shares were 3 million. On 1st September 2007, a further 600 ordinary shares were issued and fully paid in cash. So remember that if it has been fully paid, we consider for that full amount. But if it was partially paid. You consider the partial amount which has been paid. But now in this scenario, it was the addition of the issued was fully paid. That is what they mean up there, for cash at full market price. So of which BAOS over 1 knows. So BAOS is on this question. So you have with the profit after tax for the period 10, that is profit after tax, 10, 10,976,
10.
You minus what? What am I supposed to minus here? Give me the figure before I show you the figure you are supposed to minus. Which figure am I supposed to minus?
Okay.
I will minus.
Wait.
It's just direct. Remember that if you can remember your formula. So we said you start from profit after tax. You subtract profit attributable to NCI.
NCI.
Is there profit attributable to NCI here?
No.
Is there preference dividend?
Yes.
On which value? 7% of?
Of 4 million.
40 million. 4 million is shares.
40 million?
Yes, 4 million is shares.
Oh. So, okay.
If dividends are paid, dividends are paid on the value. So because 4 million preference shares of shillings 10 each, so you take 4 million, you multiply 10, then 7% of that value.
2.8.
Then what about 1-oz? 1-oz is direct. So 1-oz you consider the shares which were there from January, the 3 million. Then the additional 600 were issued on September.
3 million ordinary shares.
Yes. So we have this. Remember, these were there from January. This one,
Yeah.
They were there from January. What about 600? 600 were issued on
1st September.
So this one you wait for 4 months.
Okay.
Yes. So, and that's all. Do I have to calculate?
No, it's okay.
So anyway, that is fine. Yes. But if you are not understanding, I can again calculate.
No, we can continue.
Yeah. So then issue of shares as part of purchase consideration. Just a minute.
Okay.
So I was saying that, remember that we have already done an explanation there on the illustration, on a short illustration, of which you say you are okay with that. So the next thing is all about issue of shares as part of a purchase consideration of the subsidiary company. Issue of shares as part of purchase consideration of the subsidiary company. So when let's say a company acquires another one, or a company acquires acquires a subsidiary. Let me use that example. Let's say A acquires B. So if A acquires B, then it issues shares on such acquisition. So the shares which were issued, how will these shares be weighed? So will you weigh from the time of issue or the time of acquisition? Like now A acquires B as a subsidiary. A acquires B on, let's say, 1st January. A acquired B on 1st January, but it issued shares on 1st May. So are we supposed to weigh from the date of issue of the shares, which is May, or from the date of acquisition, which is January? So food for thought. So on this scenario, there's an illustration which will answer that question. So this is the illustration. So that details of the issued and fully paid share capital of XYZ Limited as at 1st January 2007 are as follows. So we have 80,000, 7% cumulative preference shares of 10 each. And we have 4.2 ordinary shares of 10 each. So on 1st August 2007, the company issued 20,000, 7% cumulative preference shares. And the 600,000 ordinary shares as consideration of an 80% controlling interest in another company, which had become a subsidiary on 1st January 2007. So then you are told the profit for the year ended 31st. The profit for the year ended 31st December 2007 was 27,320 for the group. Of which 740 was attributable to minority shareholders or minority interest in a subsidiary. Required. What are you required to do? You are required to calculate EPS. So I think this one needs a calculation. This one needs a computation. So let us continue with the computation. So we were talking about an illustration which is provided here. So this is the illustration. So obvious, we need to start from which part? So we are supposed to do EPS, the basic. So the basic, you know that we always say, is all about profit attributable. So we always say that PAUS is all about, not PAUS, but basic EPS, sorry for that. So basic EPS is all about PAUS over 1 So it's PAUS over 1 So let us get PAUS. So remember that PAUS, we start from profit after tax, so net income. So that is the net income, profit after tax. So which if you can check in your illustration, if we can check in our illustration here, we can see that we are told the profit after tax is, the profit for the year is 27,320. This one. For the group, which are 740 for the group, of which 740 of which 740 was attributable to the
minority.
To minority. So what am I supposed to do there? Will I record the total or I have to subtract again? I subtract. But at the same time, even if I say, so it's okay. So we take 27,320 minus. So this is the case. So I will say 27,320 minus 740, the one which is attributable to minority shareholders. So which figure are you getting there? If you take 27, you have a calculator.
Yes, you get 26,580.
26,580. So after that, remember that after that you raise what? Preference dividends.
Preference dividend.
Yes, so let us check preference dividends. So let me again display so that we check that. So you can see the preference, the first one was, because at the start of the year, you can see their capital. Their share capital was made of these two.
Yes.
So from here, we have a preference shares. We have 80,000 preference shares, of which per share is going at 10. See, so now to get the first preference shares, you take 7% times 80,000 times 10. That is okay.
Yes.
So preference dividends, you take, so I've said 7% of 80,000 times 10, because per share it was 10. So that is like 8 million or 800,000. 800,000 times 7%. So you start 56,000. That is fine. Then again, on 1st August, the company issued 20,000. This one. $20,000 cumulative preference shares. So you are told that the company issued 20,000 7% cumulative preference shares and 600,000 ordinary shares as a consideration of an 80% controlling interest in another company, which had become a subsidiary on 1st January 2007. So remember that these shares which are issued here, so this is the major consideration we need to make, because why am I doing this illustration? This illustration was concerning issue of shares as part of purchase consideration of the subsidiary company. So in order to weigh this, because these ones were issued when? 1st August. The company issued 20,000 7% cumulative preference shares and what? 600,000 ordinary shares as consideration of an 80% controlling interest in another company, which had become a subsidiary on 1st January 2007. So obvious here. Are you in class really?
Just continue.
So that,
Yeah, just continue.
so here I will just, for preference dividends, remember that I have to take the 20,000 times per share. Preference shares, our shares were going at 10, then 7%. So 7% of that. So that is what I will be doing. So the other preference shares, just you take 7%. So the preference dividends, you take the 7% times what? It was which figure? It was 20,000. And our price, obviously, it was 10. So 200,000, 7.7% of 200,000 is?
Yes.
That is 14,000.
200,000, 200 by.
So take 26.
14.
26,580 minus
14,000.
So this one would be, remember that the first one was in terms of, this one was in millions. This one was in million. It's only I reduced. It's supposed to be 26,580,000 because this was 27,320,000 and this was 740,000. I think you can see that one in the question. So 26,580,000 minus 56,000 minus 14,000. 26,510.
Yes.
So that is our pause. Then what about one-nose? So there's something here I would like you to clarify for me. But anyway, I will clarify because this is the first question. But now you need to know to understand. So remember that this illustration, the main purpose we are doing this illustration is because the issue of shares as part of purchase consideration. When are you supposed to weigh? When are you supposed to weigh these shares? Like now here you have shares which were issued on 1st August. So they issued this preference and what? And ordinary. Are we together? So there was a 20,000 7% cumulative preference shares and 600,000 ordinary. They were issued because there was an 80% subsidiary which was acquired. On which date was the subsidiary acquired?
1st January.
So when I will be doing my one-nose, which period am I supposed to consider when weighing my, remember that on this scenario first, there are two things I will weigh. So the first one is okay. That one, the 4.2 will be weighed from January. They will be weighed from January because that is the time. So this one will be weighed from January, the 4.2. What about 600,000? Will I weigh from August or from January when the subsidiary was acquired? So you need to know that
August.
that is wrong. When you issue shares as part of purchase consideration, when you issue shares as part of purchase consideration, you weigh those shares from the time of acquisition of that, from the time of that acquisition of the subsidiary. Like now here, the subsidiary was acquired on January. So the shares which are issued as part of purchase consideration of that subsidiary, they are supposed to be weighed from January. They're supposed to be weighed from January, but not August. So even if they issued these shares on August, they issued because, why did they issue? There was a subsidiary which was purchased. So, but the subsidiary was purchased in January 1st. So you weigh those shares which are issued as part of purchase consideration from January, from the time the subsidiary was acquired, not from the time when they issued the shares. So in order to determine our one-nose here, so remember that there is a 4.2, the one which was outstanding from January. The one which was outstanding from January. So that one I will arrive at 4.2. So 4.2, when I say 4.2, you know that it's 4,200,000. So the 4.2. Then the other one, The 600,000, I have said you weigh from when? You weigh from the time that subsidiary was acquired. Again, you say 12 out of 12, not from August. August is when they issued those shares. But when was this subsidiary acquired? January. So that is the time you weigh those shares from. So that is you get 0.6, which means that you take the 42, 4.2. So 4.2 plus the 600, this and this, plus the 600,000. So 4,200 plus 600,000. So that is 48. So that our basic EPS, will be, you take powers 26, I can reduce it to thousands, 26, 510, you divide by the 4,800. So if you take 26, 510, you divide by answer, you get 5 point, so that is shillings, 5.52 per share. So 5.52 per share. Any question?
You said 600. Where did you say we use 600,000?
Why?
I mean, how we have weighed the 600,000.
Remember, why was 600 issued first? Do you understand why was it issued? Why was it issued? That is a question for you. Why was it issued?
Okay.
Why did they issue 600? What's the reason of issuing this?
Let me see. The company. In consideration, it was a consideration.
For purchase of which? For purchase of?
Of a subsidiary.
Yes. So that is good. So that I said, if you issue shares as part of purchase consideration, so when you are weighing those shares which are issued as part of purchase consideration, you weigh them not from the time the shares are issued. You weigh them from the time the subsidiary was acquired. Subsidiary was acquired when, which period?
1st January 07.
Yes, so you weigh them from January 07, not the August. August is when they issued the shares, but you weigh them from the time, if they are part of purchase consideration, you consider from the time that subsidiary was acquired. So that's why I'm considering 12 months, 12 out of 12.
I get. Okay, thank you.
So that is fine. That is what we have done. We have arrived at 5.52 per share. Solent, there is another whereby there is issue of shares without a corresponding change in resources. There is an issue of shares without a corresponding change in resources. An example of that, let's say, for example, you are in a certain company. You might be working with Safaricom. So let's say you are working with Safaricom. So that in Safaricom, there's a scenario whereby sometimes they issue shares, but in those shares they issue, they don't get an equal return. Let's say we issue 100,000 shares or 1,000 shares. Once we issue 1,000 shares, the return we are getting is not equal with the 1,000 shares we issued. So on which scenarios can that happen? On which scenarios that can happen?
Pardon?
I'm saying this. Let's say, for example, you are a Safaricom.
Yes.
You issue shares to the shareholders. But what they are paying in return is not equivalent of the shares you issued.
Mm-hmm.
In which scenario, what is that? What is that now I'm trying to say? Examples of those scenarios. An example? The first example. Sorry?
Increase in the par value.
No. So what I'm trying to ask, I don't know if you are getting my question. So ordinary shares may be issued, even it's on the screen. Ordinary shares may be issued, or the number of ordinary shares outstanding may be reduced without a corresponding change in resources. If you give me shares, you are A. Instead of paying back the exact value of the shares, I pay less, or I don't pay anything. So there's no equal return you are getting. In terms of shares, this can happen when there's a bonus issue, whereby a bonus is whereby shares are issued for free at a certain exchange ratio. Shares are issued for free at a certain exchange ratio, but not to everybody, to the existing shareholders. To the existing shareholders. Let's say, for example, a company can accept that for every 4 shares you have, you are given 1 for free on a certain exchange ratio, 4 for 1 for free to existing shareholders. So that is a bonus. Each share issue at no consideration. So there is no equal return. So on this scenario where there is a bonus issue, so the shares which are issued through bonus, you weigh them from the earliest reported period. You consider them throughout the period. That is in short, that is what I mean. Shares issued through bonus, you weigh them from the earliest reported period. When those shares were entitled to, when those shareholders were entitled to dividends. Weigh shares issued through bonus from the earliest reported period. That is in short, it will be there throughout the year. So the next example, that is example 1. The next example is what we call right issue. What's a right issue? When we are companies making a right issue. Accountant, what's a right issue? So a right issue is when a company again accepts to give shareholders an option or to give them a chance. I'm saying existing shareholders are given a chance to purchase shares. So they are not given an option. They are told that purchase shares at a lower price than the existing market price. So let's say that, for example, the market price was 24. You are told that you would be purchasing shares at 14. So our exercise price would be 14. So which is lower than the market price, which was 24. On a certain exchange ratio, for every 3 shares you have, you are getting 1 at a lower price, not for free. For free needed a bonus, but now it will be at a lower price than the existing market price. That is fine.
At a lower price.
Then we have a share split and reverse. So this is what I've been explaining here. A bonus issue is the issue of shares for no consideration, for free, to the existing shareholders in proportion to their shareholdings. For every 3 shares you have as an existing shareholder, you are given 1 for free. The number of ordinary shares outstanding is therefore increased without an increase in resources. That is fine. For the purpose of computing EPS, number of ordinary shares outstanding. So the number of for the purpose of computing EPS, the number of ordinary shares outstanding before bonus should be adjusted for proportional change in the number of outstanding. So in short, with avoiding a lot of stories, you know, bonus issues whereby shares are issued for no consideration to the existing shareholders.
Yes.
On a certain proportion, eh? Yes. With the proportion of what you hold. For every 3 shares you have, you are given 1 for free. It will increase the shares, ordinary shares, but no resources. With no increase in resources. Illustration you can see there. So illustration is the summarized income statement of APC for the year ended 31st December 2007 is as follows. Eh? So we have a profit after tax. NCI, we have it. We have dividends. This is preference, not reference. This is a preference. Eh?
Preference.
This is preference dividend. So we have ordinary dividends, retained earnings, roll down, carry down. So anyway, our pause here is and
yes.
Our pause is
I'm trying to see.
That is, it's there.
Yeah, return there.
Check your network. Your network is poor, poor. You are breaking.
It is
anyway,
885.
885. This one, eh?
Breaking. It's 885.
It's my network, eh?
You are back.
There's something here we were talking about. There's a question here I was asking you that what is the relevant pause, eh? Profit attributable to ordinary shareholders. So you told me it's 885, which is correct. So that, remember that we are talking about this is an illustration of bonus, eh? This is an illustration of bonus. So they say down there the company had 500,000 ordinary shares on 1st January 2007 and 1.57% preference shares. Oh, we need to check. So anyway, I need to. So that is fine. So there is a company had 500,000 ordinary shares on 1st January and 1.57% preference shares. The company made a bonus issue of 1 for every 5 on 31st March 2007. Eh? On 31st March 2007. Eh? So remember that. Remember that Anne.
Yes.
Other than the 885 cannot be our dividend because I was not seeing the one which is given down here. There is something given down here. There is this 1.5. So remember this one, they say preference dividends including arrears. So what is our total? So you take 7% of 1,500. That is the total dividend. So you minus from 1,200. Eh? So let me so let us do compute. So I was saying that remember that here there is a profit after tax of 1218. So we can say this. So just mute. So pause. So PAUS is equals to profit after tax. So the profit after tax, then we raise the profit which is going to NCI, profit attributable to NCI. Then again we raise the preference dividends. So profit which was going to the profit after tax, in short, profit after tax in our question here is all about, I will take the 1218 minus 18. So 1218, the one which is after tax, minus the one which is going to NCI. Then I was saying now the preference dividends to raise is the one which is given down there, the 7%. 7% of 1500. So the 7% of 1500. So which is 105? 105. So that is the one we are supposed to raise so that we arrive at a certain figure there, which is 1095. 95. Then now we need to get one-offs. So this now, this is the main thing. The others, you know, for the profit attributable to ordinary shareholders, that one is okay. So now the main thing here was all about one-offs, where there is a right issue, not a right issue, but bonus issue, where there is a bonus issue. So like now in this scenario where there is a bonus issue, there's a bonus issue. Like now there's a bonus issue here, whereby they issued how many shares? 500,000 shares. So this is the 500,000 shares which were issued, the ordinary shares. So the company had 500,000 ordinary shares on 1st January 2007. Then there was a 1.5 preference shares. The company made a bonus issue of 1 for 5. On which date? On Smash. So remember that this one would be meant, the bonus would be meant on the shares which were outstanding, which is 500. But now when you weigh, are you supposed to weigh from March, or are you supposed to weigh from January? So I said this one, you weigh from the earliest, weigh from the earliest reported period, from the earliest reported period. So remember these shares through which the bonus was made, they were issued when? Those shares were issued on January. So that is from the time those shareholders of these shares were entitled to dividends. So you don't have to consider from 31st March, but you consider from January. So that's what they did down there, you can see. So there's the one which was there from January, which is okay. Then the bonus, you consider it again. You consider it again. So that we can say that there was the one which were there from January to December, the 500. So this one you consider for 12 months. So that is 500,000. Then the others which were through bonus, the bonus. So the one which were through the bonus, again for those, even if the bonus took place March, you know that the bonus took place on 31st March. But these shares which were through bonus, the 1 for 5, 1 for every 5 times the shares. Remember the shares, they are 500, the one which are outstanding, the shares at the 500. So that you get the shares which were issued through bonus. Then you weigh them. You weigh them from the earliest reported period. That is from January, but not from March. So the 100,000 you wait from January. So which means that this is 600. So weigh the shares which are through bonus from the earliest reported period, from the time those shares were entitled. So when the shareholders of those shares were entitled to dividends. So remember that when we are making a bonus, we make a bonus on the shares which are outstanding. So the shares which were outstanding from January are 500. So they were given one for every 5 shares held. So they were given how many shares? Shares through bonus are 100,000. So you weigh from January, not from March when the bonus was issued. I think that is correct. So that here we can be able to get basic EPS. So whereby I will take 1095, I divide with the 600. So I will get shillings 1.825 per share. Any question? Up to 30 point? Up to that point, Anne, any question?
No.
So the next thing is
about the bonus.
About?
So you we compute the amount for bonus from the ordinary shares outstanding.
Yes. So let's say, for example, you are a shareholder in Safaricom. They issued the shares to you on January. Remember that your shares are outstanding from January. Let's say they issued 1,000 shares on January to you.
Yes.
Then coming to May or 1st July, let's say 1st July, coming to 1st July, they accept to give bonus. So when they would be giving bonus, on which shares are they supposed to base their argument on? It's the shares which you have from January. Hello.
Can't get you.
I'm saying it is a network each all.
Yes, yes.
I'm saying this, You have shares with Safaricom. Safaricom issued shares to you of 1,000. That's fine. Yes. Are you concentrating reading in class?
I can't get you.
Why on my side I'm getting you very clear? Check on your mic.
My mic. Okay.
Why am I hearing you clear? Then you are saying you are not getting me.
Yes.
So I was saying that you have shares with Safaricom of 1,000. That's fine.
Yes,
Safaricom,
yes, very fine.
So it means that Safaricom had issued 1,000 shares to you. Let's say January.
Yes.
Then coming to 1st July, Safaricom says that we want to make a bonus of 1 for every 5 shares you have. Which shares do you have? Which shares do you have?
1,000.
So these shares of 1,000 were existing from which period? See, that is, you have answered now the question. So do you have any question again?
Okay.
So mute yourself, we continue. That's fine.
Okay.
So restated EPS, so there's something known as restated EPS. Restated EPS is a comparative EPS. So when I say comparative EPS, it's all about now, this one will assist us to check on the performance of the company. remember that EPS is one of the measure. So restated EPS is a comparative computation of EPS based on assumptions of what if the bonus issue could have taken place in the previous year. So in order to compute this restated EPS, either you have a bonus issue, you have a right issue, you have a share split or a reverse split. So if these things are mentioned, bonus issue, right issue, share split or reverse split, occurred, let's say, in 2021, and that is the time when you are computing your EPS undiluted. So in order now to compute the restated, you assume what if they occurred in 2020? You will compute your EPS for the previous year with the assumption what if the bonus which occurred in 2021, the right issue which occurred in 2021, the share split which occurred in 2021 occurred in the year 2020. What if? Then after doing that, you check on your EPSs, restated EPS and the current year EPS, so that you can be able to comment on the performance, if it was increasing or it was declining. So let's do this, assuming that the earnings, so there's an illustration there, of which I need to explain. It doesn't need a lot of computations. Assuming that the earnings for 2006, assuming that the earnings of 2006 after deducting preference dividends were 1.5, not 1.5, but 1,005,000. And that of the ordinary shares outstanding throughout the period were 400,000. Assuming the earnings of 2006